Japanese, I think it's their 40-year bond is at the highest rate since its inception. It's like 3.5% or real close to it. And so at some point, the Japanese will say, geez, we can buy our own bonds instead of getting, and the 30-year treasury is what, barely 4%, right around 4?
The U.S.
Yeah, U.S. And when you figure in the fees and everything for switching, it doesn't make sense anymore. There's 1.1 trillion in U.S. treasuries that Japanese own. And so they're going to have to liquidate them to keep their accounts from blowing up, which pushes our rates up. And that's why the Fed keeps talking about, they've lowered rates, but the 10-year treasury is not moving. Things that have caught my attention today, Monday, we're doing this Monday before Thanksgiving. We have the COMEX options expiration in both gold and silver. And then tomorrow is the big day as far as I'm concerned. It's the large traders that are or are not standing for delivery in their December contract. And if they're not, they have to roll over their contracts or sell them, which keeps them as futures contracts, of course. And if not, they're going to stand for delivery. And I think this is one of the big deals when you see silver in backwardation still, meaning that the cost of silver today is worth more than it is out into the future. It's supposed to be the opposite of that. It tells you that there's stress and strain within the market itself, and that there's a greater demand for physical metal than there is for the paper contracts that stand behind them. And this is what we've talked about for quite some time now. It started to really come to fruition, and this is a big one here. This December contract is certainly a big one. A couple other things that caught my attention over the weekend, down again. One of which we talked about. I don't know if I talked about on your show, but talked a little bit about on others. Was that the mBridge, which is kind of up from the shadows. Over the last several years. The information that I would use or find to talk about the BRICS was easier to find than it is now. It's kind of in the fog right now, if you will. And I think that's by design. They're keeping it quiet so as to not attract the attention of this administration and draw the cross-eyed look of President Trump. And one of the things, however, that did come to light was that UAE, United Arab Emirates, and China conducted another successful test of mBridge, a real-time test. For those people that don't remember, mBridge is the cross-border payment system that was designed by China, Hong Kong, Thailand, UAE, and, of course, the fifth full participant who came in a little bit later, Saudi Arabia. They're the big five, originally designed with the assistance of the BIS Innovation Hub. We talked how that went sideways when the BIS pulled out at the 12th hour. But one of the things that I find interesting, and I don't think should be overlooked, is this first trade was between China and UAE. Well, I don't think it should be overlooked that China, Hong Kong, and the UAE all run advanced precious metals markets where gold is traded in local currencies. And this enables mBridge members to convert trade surpluses, as we've talked about, directly into gold. And this bypasses the dollar entirely. This is the ultimate plan with the Shanghai Metals Exchange expansion of their vaulting system, the one that was just completed in Hong Kong. What's the significance of that? In order to take gold out of China, it has to come out of Hong Kong. So the first one was built in Hong Kong. So in an example like this, the UAE could sell oil, as an example, to China for the digital yuan over mBridge, which settles in 7 seconds, 98% reduction in fees, no U.S. or Western intermediary banks, no SWIFT. And then they can settle imbalances in gold first without converting into dollars and take possession in Hong Kong. And of course, the second vault is under construction, or will be very shortly, in Saudi Arabia. This is where it is heading, and I think that's a important piece. A couple other things that I noticed, UBS, and again, these banks are so full of BS at UBS. They're all full of it because they continue to raise their price targets. And their price targets are as useful as a mud wall. because they've been wrong continuously. Yet, okay, fine, and they acquiesce and raise it. So now UBS says, well, we're going to raise our mid-year price target to 4,500, previously 4,200. Well, geez, thanks. I think that these banks that continue to raise their targets, if you go back and look what they were a year or two ago, it's almost kind of laughable. A lot of people will talk about it. I don't even think it really bears much consideration at all. They really don't want people to know what their real belief is, and that's why you have, it's funny because I have an account with Morgan Stanley, and the guy that I work with, he's a very good friend of mine, and he manages, a lot of money with Morgan Stanley. He's one of the biggest in Florida, and he lives in my neighborhood, and he wouldn't know a gold coin if it fell on his foot, yet his chief investment officer has advocated for 20% holdings in gold, sell half your bonds. And so, it's to me, these banks and the people who work underneath them really have no clue. But when you're getting Michael Hartnett, when you're getting, again, another comment from Jeffrey Gundlach, the bond king, saying that 25% gold is not overweight. And then, of course, Michael Hartnett, as we've talked about, he's the chief analyst of Bank of America. They're talking to people above, not the successful money managers who are managing $3 billion and are at the top of their game on retail. They're talking to the people who are bringing in all the metal into the United States. They're talking to the massive traders that are doing so. And they're saying gold and silver are being, in essence, by their actions, reintegrated into the system. To me, that caught my attention. So don't pay attention to what they're saying. Pay attention to what they're doing, unless you're listening to the very, very top analysts who are speaking to the institutional traders.
Beyond metals, a quiet transformation is unfolding in global finance. The cross-border payment network known as mBridge, developed by China, Hong Kong, Thailand, the UAE, and Saudi Arabia, completed another successful real-time test. Its purpose is clear: settle international trade in digital currencies without the US dollar or Western banking intermediaries. This system not only cuts settlement time to seconds, but integrates seamlessly with advanced gold trading hubs across Asia and the Middle East. It allows nations like the UAE to convert trade surpluses directly into physical gold through Hong Kong or soon Saudi Arabia, accelerating the shift toward multipolar trade.
One other thing that caught my attention was the Ethereum founder, Vitalik Buterin. Now I'm butchering that name, but it's interesting because he was giving a speech the other day, and he says they've highlighted quantum resistance as a key element of the network's long-term roadmap. He says this comes amid a risk of quantum computing advances that could potentially undermine current cryptographic systems. Ethereum races go to quantum safe. Speaking at DE DevConnect conference in Buenos Aires, he says the roadmap for Ethereum includes goals for the next 2 years, warned that cryptography securing Ethereum and Bitcoin could be vulnerable to quantum computing breakthroughs by 2028. And it's interesting to me that the guy that designed Ethereum is saying that quantum computing can do this. And he was inspired to say this because the test was conducted by Google Quantum AI using their Willow quantum processor. We've talked about the Willow chip, caught my attention about 2 years ago. And, Google previously stated that the Willow chip could do in under 5 minutes what the world's fastest supercomputer could do in 10 septillion years. Now, I didn't even know what that meant. It's 10 to the 25th power. And so when you talk about reasons to, I think more than ever, to consider having something outside the matrix, outside the system. You got the guy that developed Ethereum, where it seems like everything trades on the Ethereum network. It's the rails of so many of the crypto tokens and really the rails of the entire system. Much of it, anyway, goes to show how naive I am with cryptocurrency. But the point of it is that When you get the guy that is the designer saying that within 2 years you could see problems or the ability of quantum computing to hack and or steal Bitcoin and Ethereum, I found it to be very, very concerning and interesting. These things you don't hear about in the mainstream, but whatever. Nonetheless, I think that's really about it. Other than, we also talked a little bit. Well, I think we should talk about one last thing, and that is, I don't think we talked enough about the carry trade, right? And I want people to understand just how significant this carry trade truly is, because for years the world was able to borrow a Japanese yen at 0% interest rates. So investors would borrow the yen in trillions of dollars. It's the biggest trade in terms of arbitrage that the world has ever seen. For a very long time, Japan kept interest rates at zero, and investors would borrow cheap yen and then they convert it into dollars. And they use that money to buy U.S. stocks and bonds or emerging market assets or whatever they wanted in Europe or wherever. And whatever they earned in dividends and interest, these gains were pure profit because the loan cost them nothing. But now Japan has raised interest rates and their currency is the rates and the value of the dollar strengthening. The trade has become uneconomical. You have 1.1 trillion in Japanese pension funds that are sitting there now, in essence, in a trade that doesn't make sense. And what's interesting is that now that the yen is strengthened, in order to convert back, they would have to buy yen at a higher rate when they bought it at a lower rate. And as they liquidate bonds in the United States, the treasuries that they're holding, 1 trillion of them, to bring it home to cover these positions, not only will interest rates go up here in the States, but all of that money going into the yen will push the yen up higher. And now you have a big, big problem. It's systemic. It's a chain reaction. And what the higher rates can do to this economy and all of that money that is poured into treasuries and into crypto and into equities is now beginning to unwind. And I think it's something people need to understand, that the selling pressure will trigger falling prices. And these falling prices, I think, will start to really, really very quickly put some of these trades upside down. And this is how you get this unwinding, this spiraling. And I think we're right there right now, because, that this yen trade represents trillions globally, and hundreds of billions of it sitting in the U.S. stock market alone. So I think people should watch this very closely. Their next meeting is coming up in December, and a lot of people think that they're going to raise rates again. And if that's the case, I think leading into the end of the year could be some massive fireworks. So those are the couple of things that I saw that caught my attention, and happy to take it any way you'd want.
Major financial institutions are adjusting their views, but often too late. Banks such as UBS continue raising gold price targets after repeatedly missing major moves. Meanwhile, high-level strategists like Jeffrey Gunlake and Bank of America's Michael Hartnett offer a starkly different tone, suggesting gold allocations of 20 to 25%, levels once considered extreme. Their deeper message: institutional flows indicate gold and silver are being reabsorbed into the global monetary system. Retail advisors remain largely unaware or dismissive, yet the actions of major players reveal a clear repositioning. Investors watching closely see the gap widening between official commentary and real behavior.
Japanese, I think it's their 40-year bond, is at the highest rate since its inception. It's like 3.5%, or real close to it. And so at some point, the Japanese will say, geez, we can buy our own bonds instead of getting, and the 30-year treasury is what? Barely 4%, right around 4.
The U.S.
Yeah, U.S. And when you figure in the fees and everything for switching, it doesn't make sense anymore. There's 1.1 trillion in U.S. treasuries that Japanese own. And so they're going to have to liquidate them to keep their accounts from blowing up, which pushes our rates up. And that's why the Fed keeps talking about, they've lowered rates, but the 10-year treasury is not moving. Why? Because they're strained. The rest of the world is selling treasuries. And when our largest creditor, Japan, decides to do this and have no choice but to do it and unwind what amounts to the greatest piggy bank that the world has ever seen. And part of this distortion, we've talked about U.S. interest rates, but you could argue a 0% for 30 years nearly interest rates in Japan has been the greatest distortion, where you borrow at zero, take the proceeds, and buy things at higher levels. But it's unnatural. It's unnatural because the money borrowed at zero is unnatural, which then flooded into our equity markets, our crypto markets, our bond market. And the unwinding of that is very dangerous. It's like, a balloon that's had constant air blowing into it, and all of a sudden there's a little tiny hole but the amount of air blowing in keeps it inflated. You pull that out and the whole thing could potentially collapse. I don't want to say that's what's going to happen, but it's that real. It is that real when you talk about what valuations are based upon taking that continuous injection of liquidity and speculative liquidity into our markets, pulling it out. It's something people should pay very close attention to into the end of the year, especially into the next meeting in Japan, where I think there's a better than likely chance that they're going to raise rates again. They have to defend their own country and have to kind of, let go of that peg that has enabled the United States and many emerging markets to experience a boon that wasn't natural. And Mother Nature always gets her pound of flesh in the end.
Even if you don't buy parquet margarine.
I remember that. You'll be sorry. Yeah, I remember that.
A new concern emerges from the world of cryptocurrency. Vitalik Buterin, co-founder of Ethereum, warns that rapid advances in quantum computing may threaten the cryptographic foundations protecting blockchain networks by 2028. Recent breakthroughs, including Google's Willow processor outperforming classical supercomputers by astronomical margins, suggest that encryption systems long considered secure may be vulnerable sooner than expected. Ethereum's roadmap now includes urgent upgrades to defend against quantum-level attacks. For investors, this raises a critical question. In a world where digital systems could be compromised, what assets remain safe outside the computational matrix?
Yeah, because in order to do what Rick is saying, which is true, that's the whole thing we learned as little kids, buy low, sell high, is that buying low takes not only conviction, which is hard enough to muster up when you're out alone from the crowd, but it also takes the time to analyze and build the conviction, right? So if everyone's saying you're an idiot, why would you do that? Well, you better be well-read and educated on your position, or you're just throwing money away if you just buy something undervalued without understanding it. The point of it is that most people don't want to take the time to protect their money the way they do, and the amount of time that they put towards earning their money. If people put just half as much effort into keeping it and saving it and preserving it as they did making it, they'd be a lot better off. And that's the problem, is that the people who understand this understand it better than their financial advisors do, because why accept information from a very, very polished financial advisor if the financial advisor looks at the world diametrically opposed to the way you do? In other words, if you believe that there is something coming, for whatever that is, if you believe the dollar's in trouble, the markets are in trouble, geopolitically, whatever it may be, and the people that are managing your money don't, isn't that a conflict of interest? Isn't that silly? Because isn't what you're seeing globally, macro, big picture, isn't that really more important really in the scheme of things as to how it affects the markets? And so that's the frustration that I face all these years when the mainstream poo-poos it. But you look back at it, and we've destroyed the mainstream, right? Gold and silver have beat the mainstream for all of these years, and they won't even acquiesce. They say you're crazy. But wait, alas, you're getting at the highest level, 20, 25%. That's good, right? They never even gave in 5%, but that hasn't trickled down to the advisories yet. Like I said, my friend who he's in the Forbes top 50 money managers in the United States in terms of the amount that he manages. and he wouldn't know gold coin if it fell on his foot. We talk about it all the time. Yeah, he's okay, fine, but he doesn't implement it at all. And his chief investment officer says, no, 20% should be in metals. The point of it is that when you have these beliefs and these feelings about being a contrarian, it's something that takes not only conviction, but it takes effort to make sure that your beliefs are right. And that's why so few people do it, Dunnigan, because it's an inordinate amount of time and effort and, trust in yourself that you're right. So that's why, I think what you and I do, and when we talk about this to people, that carries a lot of responsibility. And that's why when people say you're talking your book, no, that's not true. In a world where I'm out there talking to millions of people, I'm not talking my book. I'm talking my heart and my soul, what I truly do believe. I have better things to do than talk my book and, bastardize my family name by going ahead and doing something like this that I wouldn't believe in or wouldn't recommend to my friends and family to do. So I do the work for you. I do the reading for you. And if you choose to follow it, understand that I'm only going by what I believe and what I do myself. So I don't know what brought me down that lane, but other than to simply say that I think most people don't succeed in investing because they're not able to separate themselves, A, from the herd, and B, doing the effort and taking the time, doing the effort and the work involved with formulating your own opinion. And that's a scary thing to do for most people.
One of the largest financial engines in global markets, the Japanese yen carry trade, is now reversing. For decades, investors borrowed yen at near zero interest, converted it to dollars, and bought higher-yielding assets worldwide. But Japan's rising interest rates and strengthening currency have flipped the economics upside down. More than $1 trillion in yen-funded positions, including vast holdings of U.S. treasuries, are now vulnerable. As investors unwind positions, they must sell American bonds, pushing U.S. interest rates higher while driving yen demand even further. This self-reinforcing chain reaction could trigger severe volatility heading into year-end.
And that's why I've been so close with Rick all these years too. I've seen it with my own eyes, and he's done a lot for me as a businessman, and I've learned a lot from him just as someone trying to gather information, and he's authentic. At these conferences I go to, I'm not kidding you. He is the first one there and the last one to leave. And this is a guy who doesn't need to be there. He does his talks at most of the shows. He is the very first one to talk in the morning, sometimes as early as 7 a.m. or earlier, because the people that get up and go there are the ones that are serious. But he's there, and he's got more energy at 70 plus years old than most of the people combined in the audience. And then he stays there till the end. And I became friends with the brokers at Sprott along the way. And it's funny, we'd have these conferences in Vegas, and they're young guys. They'd go out and party, and they'd come back and they'd be like, oh no, Rick is here today. And they would be sitting, lovingly, because they knew they had to be there before the sun came up, and they knew they would be there until the sun went down. And that's a testament to a guy like Rick. And, I say that out of respect, but he's earned it. And to your point, he spends the time, and he doesn't need to do it anymore, but he does. And I think that's very telling. You just have to buy from a reputable dealer, period. I mean, the machinery that we use is expensive. I haven't looked online. I'm sure there are some that you can buy that are, if you're going to, really start to go down this road or have a lot and questioning it, I'm sure you can buy some sort of machinery that I don't know how much it costs, but there are ways to check it. But if you look, first of all, gold and silver are very hard to mimic if they're in your hand. I mean, they are in coin form. It's one of the reasons to buy coins. You'd have to be one hell of a metallurgist to hollow something out and make it look real. And it wouldn't feel real. And so I think that's why gold has been money for so long. It's very difficult to mimic. Now you could say tungsten has similar properties, but in a 400-ounce gold bar, okay, you can drill it and hollow it out, but 1-ounce gold coin's not the case. You never really hear about coins being fake as much as you do bars, and that has a lot to do with counterfeiting laws. You get caught with those, and it's a whole different deal. It's legal tender. You're messing with the Treasury of the United States or of these countries. Easier to do a bar. And there are videos out there of Pamp Swiss 10-ounce fake bars in the jewelry district. We don't really see much in the way of fakes, although we do have the high-tech machinery to check it if we need to, coming in from the secondary market or other dealers. You had mentioned to me off camera, what about the numismatics? Now, it's a little bit harder because they're certified. One of the first things to do is you can go to PCGS or NGC and type in the serial number on the coin that you own, and it has a registry on their website, so you can see indeed that it is. Now, I guess if it were really sophisticated, I don't know how they would copy those or find those numbers and be able to put coins in them that represent that. I guess they could. But look, this is why you buy from reputable companies, and don't be penny wise and pound foolish, because it's very important that what you buy is real. And if, like I'll read, I don't remember what platform I was on. I think it's X or something. And all of a sudden I get this thing that pops up and says, you can buy a complete date set of the Silver Eagles, and they're $39 a piece, and they're in, proof condition or something. And they look at the ad, I scoured it, looks so real, right? But I'd buy every one they had if that were real. But unsuspected people will buy that stuff because they should be a lot more than that. And at 39, you're not even you're just 2/3 of the way to spot, let alone the value of some of the older dates and in proof. So it's a fair question. I don't know what the machinery costs would be on a place like Amazon or something. It's worth looking. Just buy from reputable companies. It's not just Miles Franklin that's reputable. There are a lot of good ones out there, and buy from a reputable company, and you won't have those issues. That's the easiest answer I can give you. And there will be some fakes out there. So, if the deal is too good to be true, it is. Just stay away from it.
Amid these shifts, one lesson becomes clear. Markets reward those who think independently. True contrarian investing requires research, conviction, and the willingness to act before the crowd recognizes value. Many advisors still ignore precious metals despite evidence from top analysts and institutional flows. The investors who thrive are those who study macro trends, question mainstream narratives, and protect their wealth before crises unfold. From counterfeit concerns to evolving payment systems and technological threats, the landscape is changing rapidly. Those who prepare early and critically position themselves on the right side of history.